If you want to see where the global economy is heading, look directly at China's July export number, 23.9%.
Well, on paper, crossing the terminal, it looks like a standard, albeit robust, trade beat.
It does. But if you dig into the underlying composition of the first 7 months of 2026, you will see a massive physical restructuring of global technology taking place right under our noses. The value of China's semiconductor exports almost doubled.
And high-tech exports broadly rose 40.7%.
Right. Yet simultaneously, ceramics exports fell 28.3%, and traditional categories like toy exports weakened materially.
So this structural divergence is happening while China's broader domestic economy expands at a much slower rate than its strongest export industries.
And despite that domestic slowing, July's goods trade surplus still reached $112.5 billion. The data indicates something fundamental inside the global export machine is mutating.
We'll look at the margin data and the volume metrics first, because you have to establish a critical distinction immediately. Semiconductor export value nearly doubled.
But that does not mean Chinese factories suddenly shipped twice as many physical chips.
Correct. The variables here are highly complex. Prices dictate the headline value. Product mix dictates the value. Packaging and testing stages dictate the value.
You also have to account for the fact that a significant portion of the integrated circuits crossing Chinese borders were actually fabricated elsewhere in the region.
Right, merely stopping in mainland facilities for final assembly.
Yeah.
Furthermore, artificial intelligence did not generate every single extra dollar of those exports.
That aligns with the broader macroeconomic trade data. We are tracking contributions from electric vehicles, heavy machinery, industrial metals, conventional consumer electronics, and standard shipment timing fluctuations.
But artificial intelligence is exposing a much larger structural shift in how physical global trade operates.
It is, because artificial intelligence is heavily marketed to the public as software. However, building that software is increasingly a massive, capital-intensive industrial project.
Consider the hyperscalers, the massive cloud computing providers driving this cycle. Their capital expenditure figures are staggering.
Let us run through those numbers. Alphabet spent roughly $44.9 billion on capital expenditure in a single quarter,
with the vast majority of its technical infrastructure investment allocated to servers and related computing capacity.
Microsoft reported quarterly capex of roughly $41 billion. Meta's 2026 capital spending outlook moved into an extraordinary range of roughly $130 to $145 billion.
Those budgets do not remain inside Silicon Valley bank accounts. They have to translate into physical metal.
That capital becomes processors, it becomes high bandwidth memory, enterprise network switches, optical transceivers, and high-density printed circuit boards.
It translates into enterprise storage arrays, power electronics, specialized cooling equipment, industrial step-down transformers, and the actual factory machinery required to build these components in the first place.
So once artificial intelligence algorithms require physical infrastructure to function, they immediately become physical trade crossing oceans.
But look at the core contradiction here. Western economies are deploying extraordinary amounts of capital to rapidly expand AI capacity, while concurrently attempting to reduce their reliance on Asian technology supply chains.
Which raises the obvious question for policymakers. If the United States and Europe are pouring billions of dollars into domestic semiconductor manufacturing through various subsidy programs, doesn't that capital deployment solve the strategic dependency issue?
That assumes you can build a functioning data center out of logic chips alone. You cannot.
Right. Both of those objectives, expanding capacity and reducing dependency, make strategic sense in isolation.
But achieving both quickly and simultaneously is inherently conflicted. You cannot decouple from an industrial base at the exact moment. You're relying on that exact same industrial base to manufacture the most capital-intensive infrastructure build-out of the decade.
Because the physical realities of a server deployment require the entire ecosystem, let us trace how that capital actually flows by following a single artificial intelligence infrastructure dollar.
A major cloud company approves another massive block of computing capacity. The first-order story in the financial press is usually the accelerator.
Perhaps the chip architecture was designed by engineers in California. Perhaps the advanced logic was fabricated in Taiwan. And perhaps the high-bandwidth memory modules were sourced from South Korea.
But an accelerator chip sitting on a desk cannot function as an AI data center. The actual deployment requires high-density circuit boards to mount the processors.
It requires advanced optical equipment to move massive data sets between those processors with near zero latency.
It needs power conversion units to handle the electrical load, enterprise storage to hold the training data, specialized copper connectors, liquid cooling manifolds, advanced packaging, rigorous automated testing, precision milled server enclosures.
And critically, the underlying industrial equipment capable of manufacturing all of those discrete components at a massive commercial scale.
That physical requirement is precisely why the regional export numbers provide a much clearer picture than the bilateral nation-to-nation data.
Let us look at Taiwan. Their total exports reached about $75 billion in July, rising more than 30% from a year earlier.
Their electronic component exports climbed at an even faster rate.
Concurrently, South Korea's semiconductor exports surged as global enterprise demand for advanced memory and high-capacity storage accelerated.
Which means framing this macro event simply as a Chinese AI export boom misses the entire system architecture.
The stronger, more accurate analytical frame is an integrated East Asian production network, one in which different regional economies control highly specific layers of the value chain.
Taiwan remains absolutely central to advanced semiconductor fabrication. South Korea holds enormous structural leverage in high-bandwidth memory and enterprise storage capabilities.
China, meanwhile, possesses unusual and deeply entrenched breadth across conventional electronics, industrial components, manufacturing inputs, and high-volume production scale.
And concurrently, we are seeing Southeast Asia become increasingly critical for testing, packaging, electronics assembly, and specialized semiconductor-related manufacturing.
So artificial intelligence does not possess a single national supply chain. It relies on a regional industrial architecture.
AI capital expenditure essentially become component orders. Those component orders become factory utilization rates. High factory utilization rates become exports.
And those physical exports finance the next round of regional industrial investment. Higher utilization spreads fixed operating costs over more physical output.
If pricing remains healthy across the cycle, gross margins improve, free cash flow rises, suppliers can afford to automate their lines, production capacity expands, unit costs fall.
And that specific manufacturing scale becomes incredibly difficult for Western competitors to match economically.
You are outlining the optimal mechanism, but you have to account for the inherent balance sheet risk hiding inside that cycle. The primary risk is overcapacity.
A manufacturing facility running near maximum utilization can generate highly attractive returns on invested capital.
However, a factory built and financed for projected future demand that never actually materializes quickly becomes a severe balance sheet liability.
So an AI export boom is not automatically an AI profit boom for the underlying manufacturers.
The real economic variable dictating returns is whether end-user software demand expands faster than the physical manufacturing capacity being brought online across Asia.
If you are an equity investor analyzing the supply chain, you are likely focused on the headline export numbers. But you should be making a critical distinction that financial markets routinely overlook.
Export value is not the equivalent of domestic value added. The customs label tells you where the finished product crossed a border.
It does not tell you where the economic value was actually created.
Look at the physical product itself to understand why. A high-density server leaving one specific country can contain intellectual property generated in another nation, logic silicon fabricated somewhere else entirely.
Memory modules imported from a third economy, and it might have been assembled using precision manufacturing equipment imported from a fourth.
As these supply chains become increasingly fragmented, that specific distinction dictates where capital should actually be allocated.
A high-end accelerator may represent a very large share of a server's total bill of materials in terms of sheer dollar value.
But a significantly cheaper component can still halt the entire data center deployment if there is no immediate substitute available.
So if the most expensive component does not dictate who holds the leverage, where does the real power sit?
It sits with the bottlenecks. Optical networking is the primary example of this dynamic. Think of the advanced accelerator chip as a genius mathematician.
Optical networking is the specialized highway system that delivers complex data sets to that mathematician.
If the highway is backed up, it simply does not matter how fast the mathematician can calculate. Chinese manufacturers have built exceptionally strong market positions in optical transceivers and related communication components.
The dollar value of those specific parts may be tiny compared to the cost of a flagship accelerator, but their operational leverage is absolute.
Without them, the computing cluster cannot communicate.
You are illustrating the difference between value share and bottleneck power. An equity investor typically asks, which supplier captures the most total revenue?
A data center operator asks a completely different operational question. Which missing component prevents the billion-dollar cluster we already purchased from being switched on?
That simple question changes where the structural leverage sits in the market, and this underlying logic is spreading rapidly beyond optics into power and thermal management.
Because the physical constraints to the hardware are forcing a reallocation of capital. When you stack that many high-powered processors together in a single server rack, they generate enough thermal energy to literally melt the infrastructure.
That is why you suddenly see a massive spike in capital flowing towards specialized liquid cooling systems, advanced thermal management, and power distribution.
The computing density is increasing so fast that traditional air cooling is no longer physically viable.
Which means the AI trade story broadens significantly. The next phase of the cycle will not be measured solely in logic accelerator shipments.
It will be measured in everything required to make those accelerators functional and usable at commercial scale.
You have to monitor the exports of power conversion units, heavy-duty electrical switchgear, liquid-to-liquid heat exchangers, and the specialized metal tubing required for in-rack fluid distribution.
We also have to integrate tariffs and geopolitics into this system model. The simple political narrative suggests that if a government raises tariffs on Chinese goods, Chinese manufacturing automatically loses the order.
Sometimes that happens. Tariffs certainly can reduce direct bilateral trade volumes.
They can theoretically improve the baseline economics of domestic manufacturing, but raising the floor price of imports. They can accelerate supplier diversification and redirect corporate capital investment toward allied markets.
But modern, highly optimized supply chains do not always respond to friction by disappearing. They respond by changing geography.
That requires precision in how we interpret the trade data. Trade rerouting is not automatically illegal transshipment.
A corporation can genuinely move its final production facilities into Vietnam, Malaysia, Thailand, or Mexico.
Local workers in those specific jurisdictions can perform real, complex manufacturing tasks. Local suppliers can contribute meaningful economic value to the product.
Goods can legally acquire a completely different country of origin when they satisfy the applicable international trade rules regarding substantial transformation.
So the useful conclusion for capital allocators is not that tariffs are entirely ineffective. The useful conclusion is that tariffs can change final assembly trade flows much faster than they can change upstream industrial capability.
Southeast Asia makes this dynamic highly visible right now. The region has become increasingly vital as a connector between major global economic blocs.
Economies like Malaysia, Vietnam, Thailand, and Singapore can provide vital assembly, advanced testing, sophisticated packaging, and regional logistics capacity.
But many of those new multi-billion-dollar facilities still depend heavily on upstream components, specialized chemicals, precision machinery, or intermediate electronics supplied directly from elsewhere in Asia.
That model functions perfectly, assuming the raw materials and intermediate goods can flow across borders without interruption.
The supply chain can become less reliant on China at the final assembly stage without becoming truly independent of Chinese upstream inputs.
This is the definition of partial rewiring. Partial rewiring can still require real factories, real labor pools, and real capital investment.
But it is a very different economic proposition from replacing an entire upstream ecosystem.
Because replacing an upstream ecosystem is brutally expensive. A final assembly plant can be announced relatively quickly in a new jurisdiction with the right tax incentives.
A deep, resilient supplier network takes years, sometimes decades, to build.
It requires specialized chemical and material suppliers. It requires precision tooling, advanced process engineering, rigorous quality control frameworks, highly trained labor, reliable power grids, and critically, enough aggregate commercial demand to run the entire system at a competitive scale.
Which explains why supply chain resilience fundamentally costs money. Companies attempting to execute this geographic shift may be forced to carry a significantly more inventory on their balance sheets to buffer against logistics shocks.
They have to spend operating capital to qualify duplicate suppliers. They may have to operate newly built plants below maximum efficiency during long ramp-up periods.
They must accept longer, more complex logistics chains, or they must deliberately choose to pay higher unit prices to reduce their strategic dependence on a single region.
This raises the essential question of who actually benefits if this industrial cycle continues to expand. The assumption that Asia wins is far too broad for serious financial analysis.
The answer depends entirely on which specific layer of the architecture remains scarce.
Advanced foundries benefit, while leading-edge fabrication remains technically difficult to replicate. Memory suppliers benefit when high-bandwidth memory stays structurally tight due to yield issues.
Optics suppliers benefit when cluster networking becomes the primary performance constraint.
Power and cooling companies gain when computing density forces data centers to retrofit their infrastructure.
PCB and basic electronics manufacturers benefit when aggregate server volumes rise globally.
Southeast Asian economies gain if they can successfully transition from simple box assembly into higher value testing, advanced packaging, fabrication, and domestic equipment production.
And Western manufacturers can certainly benefit, provided their governments and enterprise customers are willing to pay a structural premium for domestic or allied manufacturing capacity.
But there is no permanent winner written into this capital cycle. Every shortage in the market creates a massive financial incentive to build new capacity. High margins attract capacity.
And that capacity eventually attacks those high margins. That is why tracking headline revenue growth is entirely insufficient.
For institutional investors, the more useful analytical dashboard sits below the national export figures. You have to watch shipment volume against average selling price.
You must track factory utilization rates, raw material inventory levels, gross margins, days sales outstanding, customer concentration metrics, and capital expenditure plans.
But most importantly, you have to track free cash flow after that massive capex is deployed.
A supplier growing simply because global market prices temporarily surge during a shortage is not the same quality of business as one gaining sustainable long-term unit share.
Furthermore, a manufacturer expanding its physical footprint aggressively while its primary Western customers are simultaneously financing alternative suppliers in other countries may be reporting its absolute strongest financial numbers shortly before the competitive environment becomes significantly harder.
We also have to look at the other side of this equation inside the domestic Chinese economy itself. Not every industrial sector participates equally in this high-tech boom.
Advanced electronics can expand rapidly, while older, traditional export categories like ceramics weaken.
Capital moves toward the yield, credit moves toward the growth. Skilled labor moves toward the wages. Policy attention moves toward the strategic sectors.
Some factories become strategically vital to the global AI build-out, while others become structural excess capacity. And excess capacity does not disappear quietly from the market. It searches aggressively for foreign orders.
That is exactly where a localized technology boom can become a global pricing problem. If regional manufacturers add physical production capacity faster than end-user AI demand actually grows, buyers gain immense leverage.
Hardware becomes significantly cheaper. Margins compress across the entire sector. Export competition intensifies globally as factories fight to maintain volume.
For a Western hyperscaler purchasing the equipment, that deflationary environment can be excellent for their own return on invested capital.
But for the supplier that financed the new factory using high-yield debt, it can be incredibly painful.
Let us project the timeline toward 2030 to evaluate the macro environment. 3 specific variables will determine how far artificial intelligence actually rewrites global physical trade.
The first is hardware intensity. If AI inference spreads broadly through enterprise software, automated factories, robotics, autonomous systems, vehicles, and consumer devices, aggregate demand expands far beyond a small number of giant training clusters.
That scenario requires more memory, more networking, more local storage, more power management, more frequent hardware replacement cycles, and vastly more physical trade across borders.
But there is a structural counterforce to that projection that you have to model. The AI software models themselves can become significantly more computationally efficient.
Chip architectures can improve. Software optimization can extract more useful output from the exact same amount of installed hardware.
If compute efficiency rises faster than everyday AI usage, the volume of hardware required per unit of useful output actually falls.
That dynamic would severely weaken parts of the current manufacturing boom because the massive scale-out would no longer be necessary.
The second variable dictating the next decade is localization. Can the United States and Europe build genuinely competitive upstream alternatives?
We're not talking about merely subsidizing final assembly plants. We are talking about raw materials processing, advanced components, industrial manufacturing equipment, deep engineering talent pools, rigid supplier qualification frameworks, and achieving enough operational scale to actually approach Asian unit economics.
If they can achieve that, more AI value-added remains inside protected Western markets.
If they cannot, localization mandates may improve strategic resilience on paper while simultaneously raising the total cost of deployment across the entire economy.
And the third variable is capacity discipline. This is probably the dynamic that financial markets will feel the fastest.
If global suppliers expand their manufacturing footprints roughly in line with actual software demand, scale can strengthen their competitive advantage and support healthy, durable returns on capital.
If capacity expands faster than deployment, the exact same manufacturing machine becomes a massive deflationary force. Prices fall, margins weaken.
Factories are forced to compete aggressively for utilization just to cover their fixed operating costs. Exporters will search more aggressively for new international markets to dump excess volume.
And that is the exact point where the fundamental interests of technology companies, governments, and investors begin to severely diverge.
A cloud computing company wants the absolute cheapest possible hardware to maintain its own operating margins. A government may want domestic production to ensure national security.
A defense planner wants systemic supply chain redundancy. A shareholder demands higher returns on invested capital. A downstream enterprise customer requires absolute reliability.
Those goals can coexist in theory, but they rarely coexist at the lowest possible cost.
So does 1 month of 23.9% Chinese export growth prove that China has become the world's singular AI hardware foundry? No. That conclusion would be much cleaner than the underlying evidence allows.
What the detailed numbers show is far more important for capital allocation. The AI investment cycle has become large enough to fundamentally influence trade flows across multiple East Asian manufacturing economies.
China matters deeply because of its unmatched industrial breadth and scale. Taiwan matters because of its absolute dominance in advanced semiconductor fabrication.
South Korea matters because of its structural grip on memory and storage architectures. Southeast Asia matters because its role in physical production, testing, packaging, and regional trade is deepening rapidly.
And Western technology companies matter because their massive, multi-billion-dollar infrastructure spending is the primary demand engine pulling capital through this entire system.
And that leads directly to the durable thesis we are tracking across these markets. Western AI capex can actively strengthen East Asian manufacturing capacity, even while Western governments spend heavily to reduce their strategic dependence on that exact same production network.
Those two structural forces are operating simultaneously in the global economy, which means relying on a simple tariff map is no longer sufficient for serious macro analysis. You need a comprehensive component-level value chain map.
You have to trace the foundry, trace the memory, the optics, the circuit board, the power system, the thermal cooling infrastructure, the final assembly site.
Then you have to rigorously calculate exactly how much capital and time would be required to reproduce each specific capability somewhere else in the world.
Yeah.
That is where the real economic constraints appear.
By 2030, the strongest economies may not be defined only by who develops the most capable software models. They may also be defined by who controls the physical factories, the supply chain bottlenecks, and the specialized supplier networks that allow those advanced models to be deployed economically. The software race decides what AI can do. The industrial race decides how cheaply and how independently the world can use it.
If you value analysis that follows technology spending through factories, markets, and global power, subscribe to the Unlayered Global. Tell us which will matter more by 2030. The race to manufacture AI hardware at the lowest cost, or the race to manufacture it without strategic dependence. Because when the monthly trade headlines are forgotten, one question remains. When AI capex crosses a border, who keeps the value added?